Okay, time check, 5 minutes past 9. I guess it's a good time to start. Um, I officially welcome everybody to today's session. My name is Ernest Edu Owusu. And I'll be moderating today's session. Um, it's great to have you all here. This is I guess, the decision of the market color. And like we advertised, it's going to incorporate a half-year review, and then also we will look into the March started possibility of the reopening of the bond market. For those of you joining us for the very first time, Market Color is our space to bring together industry players, our colleagues, and friends of the market to usually discuss trendy topics and share some practical insights. You can actually think of it as a forum to inform people, exchange ideas, and for the want of a better word, let's say sharpen our perspectives on what's really moving the market. Basically, that's the objective of hosting Market Color. Today, we will be hearing from Enoch Sunkari, and this wouldn't be the first time we are receiving this gentleman. He's with the Black Stars Analytics Research and Insights Desk. He would be the one to walk us through the August 2025 Market Color Report. You can expect some deep insights on Ghana's macroeconomic outlook. He would touch on fixed income, equities, and also what the shifting debt environment means for you and I as investors and then also as market participants. Like always, if you have any comments or questions along the way, please feel free to drop them in the Q&A box or the chat box. After the presentation, we would read them out for contributions and then answers as well. Also, if you want to speak out loud too, we can actually allow your mic so that you share your contributions or ask your questions. And a little heads up, before we wrap up today's edition, we will share a big announcement and take a quick anonymous poll together. So please stay with us throughout and let's do this together. Without wasting much time, please let's welcome Sunkari Enoch to take us through today's edition.
Okay. Good morning, everyone, and welcome to today's session of the Market Color. Just to be sure, can I be heard and is my screen visible?
Yes, you're all good. Loud and clearly, and then also your screen is visible. Please proceed.
Okay, sure. Then let's kick off. As rightly said, I'm Sunkari, and then I'm with the Analytics Research and Insights Desk of Blackstar, and we'll be in charge of today's session of the Market Color. As Ernest rightly said, we'll be looking at the recap of the market, what has happened to the market. I think this year was an interesting year. We saw a lot of things happening on the market within a short period of time, specifically within the first 6 months of the year. Coming into this year, I think last year, so when we did our full year recap of 2024, we kind of labeled this year as a year that we're going to run with whiz, and then 6 months on, realized that even though we expected this year was not going to be an easy one, it was going to be a difficult one. That's why we liken it to being waste. But I think we're able to really run well with the weight on our head. And then when we look at just the first 6 months and we recap, then we look at the market and all that has happened within that short span, we felt like it was a preset for a rebound of the economic landscape of the country. So this morning, I'm going to take you through quickly what the year has for us and whatever that has happened within the first 6 months, as well as just as well as the few months after June. So we are going to start with our market update, and we'll look at some of the key mentions in our budget review by the Honorable Minister of Finance, and we'll also look at the possible reopening of the re-entry of the government into the bond market, as mentioned in the budget. So for the macro landscape of the country, I mean, I think by now it should have been evident in our everyday life. Um, when you look at economic growth of the country, this just the first quarter numbers we had, the economy expanded about 5.3%. And then if we look at it, it's actually position us few points ahead of our year-end target of 4%. And when you look across Africa, it's not only Ghana who was able to really expand within the first quarter of 2025. We saw some other major trading economies in Africa also expanding equally. So we saw Ghana troll just behind Senegal, Uganda, and Rwanda in economic growth, where Senegal expanded about 12%, 12.1%. Just what is peculiar here is that we saw contraction of just two economies. We saw Botswana and Mozambique contracting. And in Botswana, their case is almost similar to Ghana. The risks that we keep saying about our mining sector, Botswana actually is heavily dependent on the mining, diamond mining to be specific. So in Q1 2025, where we realized that the diamond output, that's the amount mined in diamond mined in Botswana, fell by almost 8.1%. And this was because the mining sector and the quarry sector is kind of like really dominated by diamonds and so. And this decline actually pulled the whole sector down by 7.7%, which led to the contraction of the whole economy. I think this was driven mainly because of the global weak. The demand for diamond globally was weakening in the first quarter of the year. This was because major buyers like the US, China, India decided to cut back on diamond purchases due to slower global economic conditions. And then the forecast, see, when we came into 2025, the global analysts were forecasting that the economy was going to slow down because of the challenges we're coming to face in terms of global tariffs and global trade. We also saw Mozambique also contracting about 3.9%. I think that was for Mozambique, their case is a bit different. It was mainly driven by, if we look at just a few months into the latter part of last year, there were widespread protests and clashes that was sparked by the elections in the late 2024. And this severely disrupted their business activity, their trade, and also the economic environment. And what we saw is that they are kind of like a spillover of these things I've mentioned into 2025, the first quarter, which led to the contraction of their economy. So when you look at Ghana's growth, I think, as I said earlier, we grew by 5.3%, which was largely driven by the fishing industry. The fishing industry alone expanded about 6.4%, which emerged as the highest subsector in the economy to really expand that much and also drive the growth of the first quarter. I think the Ghana Statistical Service actually attributed this dramatic growth in the fishing industry to increased catch volumes and also better government policies that aided in their logistic infrastructure. So if we look at one thing that is also peculiar here is our cocoa sector. Our cocoa sector, which is one of the major forex exchange earner for the country, and also one of the key rich natural resource that we actually benefit quite significant from, also expanded for the first time in three quarters. Yeah, I think in in the third quarter of 2024 and also the fourth quarter of 2024, we saw significant contractions of the sector. And then coming into the first quarter of 2025, we saw an expansion. This is not only that. I think in 2019, we expanded about 5.4%, and then coming to 2022, we did 0.9. It started reducing from that, and then when we go to 2024, the sector actually contracted about 22.4%, but we are seeing kind of a rebound in the first quarter of 2025. I think when you look across this is really a good thing to highlight here, because when you look at the cocoa sector of Ghana, when you look at cocoa and gold, they are the primary foreign exchange and for the country. As we've seen this year, how gold was able to benefit us in terms of FX and currency. So when you look at Africa alone, Africa controls about 73% of global cocoa, and Ghana contributes about 30% of that production. So what this means is that if the global cocoa industry is what is forecasted or estimated to worth about 200 billion, Ghana earns almost getting to 2 billion. That's kind of like 1%. Just to put it in perspective, that's like 1% of the global share of cocoa output. So if the it was facing challenges and it's beginning to rebound, it's a good thing. I think we should need to really appreciate and also look at ways to really keep this expansion to higher level. I think the end goal should be that we should be able to increase our share from 1% of global output to maybe if we get to 5, if we are making 2 billion from the global output, if we get push the percentage, our share a bit higher, we may be able to get a lot more from the sector. So it's a good thing that we are seeing an expansion in that sector. Um, um, when you also look at the by sectors, when you look at the agri sector, if you look at the sectoral performance of our major contributors to our GDP, then especially let's start with the agri sector. So when you look at the agri sector in Q1 alone, we did about we were able to, the agriculture sector contributed 83 billion, and that's almost like 23.5% of Ghana's GDP. When you look at the sector was able to grow by 6.6% in the first quarter, which is almost double, more than double the pace it grew at in the same period last year. When you compare to the same period last year, that's first quarter of 2024. I think the growth was actually fueled by crops. Crops went expanded. Crops subsector expanded about 6.7%. The fishing sector also expanded of 16.4%. I think this is commendable, right? And then if we look at 2025, the government is expecting that the agriculture sector is going to expand by 4.8% from the 2.8% it did in 2024. So I think there are also some key initiatives that are being put in place to foster this growth expectations we have. I think we've seen that in the budget. The Honorable Minister of Finance mentioned that the Ministry of Food and Agriculture was able to secure some advanced equipment to help analyze fertilizer companies for the agriculture sector. And I've also seen that they're also supporting farmers with hybrid maize seeds, and then also some other certified rice seeds, as well as fertilizer to multiple grows. Now, we're also seeing government also mentioning that the Afram Plans Economic Enclave Irrigation Project was also almost halfway complete. I think this is one of the things that we need to pay much attention to. The water has actually moved, and then irrigation should not be something that should be far-fetched for us. I think if we are able to harness that, we may significantly increase our agriculture output in the country. But when you look at the farming sector in Ghana, I think one of the key things we still think is not well thought of, or we are not seeing a lot of efforts in that section. We just realize that our farming still remains heavily under mechanized, and this is your technology is driving growth in other parts of the country, in other parts of the world. And if Ghana, we are still farming, trying to do agriculture in an under mechanized environment with all ideas or tools or methods. I think this is still something that we need to be talking about. As I mentioned earlier, the irrigation idea from the Afan Police side is a good one, but what we think is that irrigation is a low hanging fruit that we can easily harness to drive the agricultural sector. So when you look at so when you look at So they only look at the industrial sector. The industrial sector added about 104.9 billion in the first quarter of 2025, which represents about 29.7% of GDP. If we also look at some sectors actually contracted, but when you look at um, the manufacturing sector, it was able to grow by 6.6% only in the first quarter of 2025, which was able to drive the growth in the whole industrial sector. And we look at the budget government when the Minister of Finance came to Parliament to read the budget. He also mentioned some key policies that they are putting in place to be able to drive growth in the industrial sector. The minister mentioned that Make 24 was one of the key areas under the 24-hour economy that they were trying to tilt towards the industrial sector, and the Make 24 is going to set up in the Make 24, what they are intending to do is to set up an agro-industrial park for textiles, pharmaceuticals, and in food processing in subsectors of the economy, which they are targeting to make sure that they run 24/7 to drive growth in that sector. What we also saw was that they also make mention of what they call the Connect 24, which they're trying to kind of transform the Water Lake into a cost-cutting inland transportation link, I think, between the northern part of Ghana and then also the southern part of Ghana for easy transportation of goods and service. I think year on, we normally see a lot of these good policies or initiatives or government flagship programs that come on board, but the implementation has always been the biggest problem. And then we think that if some of these things that are nicely mentioned are nicely implemented, the output is going to be great, and then the benefits is going to be really, really great and help the country. So when you look at the services sector, which contributes almost the largest share of our GDP, our 46.8%, was will continue to and also continue to play a key role in the industry, as because it supports much of the employment generation in the economy. When you look at in the first quarter of 2025, it was able to expand by 5.9%, and most of the service sectors also grew in the first quarter of 2025, which were mainly led by the ICT subsector of the services sector. So when you look at the forecast for 2025 is expected to grow at 3.8%, and also rising to about 4.8% in 2027. And when you look at the service sector, I mean, we need a big push. There are also some other initiatives or government flagship programs that are also tilted towards that sector to be able to steer the expected growth in 2025, even though the growth is expected to slow down. But I think that is expected, because if we look at the policies, most of them were geared towards the industrial and agricultural sector, especially under the big push and the 24-hour economy. If we look at the policies of this new government, most of them are tilted towards the agri and the industrial sector. So when you look at the services sector, there are just a few things that were mentioned there. They mentioned what they call the Show 24, which is an initiative project for the creative subsector of the economy, and they're expecting that the creative subsector of the economy should hit a share GDP of 5% by 2029 with these projects, creating about 10,000 jobs for Ghanaians. And I think when you look at, despite its resilience and all of that in the service sector and the strong economic role it actually play, the service sector is actually largely driven by it's largely informal, with small enterprises which are facing productivity and then also poor access to finances and then infrastructure. I think this is also one of the things that we expect the government to look at to make sure that the service sector is able to access finance, and then also make the business environment good for them to be able to drive this growth. When you look at this year, one of the miracles that happened this year was our CD, our currency. The CD was able to rally against the major trading economies and then strengthened almost up 50% year on year. If you look at where we were last year and then this year, the CD was able to really outperform and to the extent that it was one of the best performing currencies in Africa so far this year. When you look at it by the seasonal disintegration, when you look at it, the last time we had such a good run, the cedi had such a good run against the dollar in the month of February, March, April was in 2016 and 2019. But this year we are seeing it's kind of like repeating itself in 2025. So they even look at the month of April and in May, the cedi really rallied against the other major trading currencies, especially the dollar, up by it almost getting to uh, only in May, the city was able to do 70. The city was able to do 37.9%, and that's incredible and also a good one. When you look at price stability in the economy, we've seen inflation, which was averaging 20s in 2024. We've seen that this year is really trending downwards, and then it's almost closer to the year-end target of our 11.9%. I think when government mentioned it first, everyone said it was an ambitious move, but just 7 months on, we are almost closer to the year-end target of 11.9%, which is also a good thing. So when you look at the fiscal performance of government also in the first 6 months of the year, but just before we go, I think when we started this year, government, and as I said earlier, government set a lot of ambitious targets and which receive widespread media criticisms and commentary. We saw that a lot of people were saying that, oh no, government, this year, these targets you are setting, we're going to be able to achieve them. I think 7 months on, we've seen inflation, we are almost there. And I think even despite this solid performance in the first quarter, all we saw was that most of the macroeconomic targets that government set, the Ministry of Finance set, were not changed. I think maybe this is just to be very conservative and also put it that low so that they can easily beat their targets. So when you look at inflation, for instance, as I said earlier, we targeted 11.9 at the beginning of the year, and then just in July, we're down almost to 12.1%, which just leaves us about some few bips away from the actual target. And when you look at our GDP, as I said earlier, we are targeting 4% this year, but we've done 5.3% already in first quarter of the year. I think when you look at IMF also did another fourth review, and then also most of their targets earlier on, even though they mentioned some of the fiscal slippages we had in 2024, which derailed the program, and which really was a bad thing that happened in the latter part of 2024. But when you look at their targets this year, they are also still in line with what they had earlier on. Let's look at IMF is targeting that inflation is going to hit 12%, and then we are just 0.1% away from that. And then growth, both government and IMF are in line. They are all targeting about 4%. When you look at our reserves, which IMF is actually watching keenly for us to really build and preserve, they are targeting that we get above 3%. 3.3 months of import cover. And then I think by the so when you look at the IMF review, the key things that we actually mentioned, they keep stressing on our energy sector as well as our cocoa sector. As I mentioned earlier, if you see that we were contracting earliest in the earlier quarters, but just rebounded in the first quarter of 2025. We look at the fiscal performance of government in 2020, first half in the first half of 2025. And on the revenue side, government only came short by 3.2 billion, which was like 3% below the actual target, which is commendable. I think government is showing fiscal prudence here, even though we expect that they should be able to raise more and more and more if some of the leakages and then the blockages we have in our revenue collection are solved. And we look at the expenditure part. The expenditure was also came. The government was also able to spend 18.4 billion less than the estimated 2.8 billion in the first half of the year. But when we look at the yearly target, as I said earlier, even though most of the macroeconomic targets were left unchanged, were not revised, but our revenue and expenditures were revised. I think government revised their revenue target of 227.1 billion Ghana cedis to 229.9 billion Ghana cedis, which is about 16.4% of GDP. When you look at expenditure, it was also revised downward from 283.9 billion to 282.5 billion, which is about 20.2% of our GDP. And this is going to leave us with a deficit of about 52 billion. When you look at this deficit, that is one of the key things we're going to focus on in this session of the market color. As we said earlier, we're going to look at government plans to re-enter the bond market. And then the idea is that I think government is willing to return back to the bond market because of this particular deficit. They are seeking to fund a large chunk of it to the domestic means. That's if they can really get that. So when you look at it, and this is not the first time government is going to be funding its budget with truly the domestic market. It has been doing that for quite some time. And if we look at our budget, deficit financing sources, we realize a large chunk of it actually comes from domestic sources. So when we look at the T-bill market this year, when we look at the T-bill market this year, a lot of there was a little bit of game play here. This year, I think government is trying to be disciplined, but the market is also tempting government to be to not stick to its plan. So when we entered this year, I think rates were still up, and then investors were locking in. I mean, it was just day as usual in January. I think January was just day as usual, high risk. You come to market, everything get taken. But when we go to February, I think government started to work and then realize that things began to change. In February, for instance, we realized when rates started to drop somewhere in February, and the investors were trying to lock in. I mean, when rates started dropping, we started saying it was going to be unsustainable, right? But still, we saw the investors were trying to lock in on the higher rates, so they come to auction in large volumes and then get rejected. I think what happened was that this year, they tried to lock in the rates somewhere when they started falling in February, and they got rejected. And then, I mean, but BOG was still offering a good lunch at their site. So most of the money, we realized that found its way into the BOG auctions. As you can see, when you look at starting from January, February, March, April, we saw the BOG auctions started to increase all the way from 9.4 billion in January to 33.3 billion in as of April. And then when BOG also collapsed their site, I think somewhere in July, BOG dropped rates to the tens, and we saw investors coming back to the GOG side of the divide and then tendering as high as 58.2 billion and got about 24.9 billion of it was rejected. I think what we were expecting is that the rate should be low, and then both on the BOG and then the GOG side. And I think this was just to pave way for the private sector in terms of credit. I think this time around, all the investors are around thinking of how to efficiently deploy capital in case we get to the actual times or days where both BOG and GOG side offer really low yields. So if this interplay that happened between BOG and GOG was able to drive rates down to the tens. I think when you look at the short end of the curve, we realize that 91 day, 182, and then to the 3640 pips are going for 10, 12, and 13 respectively. When you look at our equity market, it's also booming this year, seeing financial stocks rallying almost 79.8% this year, with non-financials up over 45%. And what we've also seen is that we've seen our market cap as it should be. It's also rallying to. Our stock market is actually worth about 446 billion, and that's really a good thing we are seeing this year. Even though we are even hearing about some companies having intentions of coming to the market. I think when the Minister of Finance uh, went to Parliament to read the budget, actually made mention of NIB being on the list of companies they are trying to bring to market on the Ghana Stock Exchange. And we also heard about news earlier on this year about Casaprep also preparing to come to market. I think these are good initiatives that are happening within the stock exchange side of the market. And then if we look at the actual listed stocks year to date, I think we've seen a lot of significant gains. I mean, our market is even performing more than the S&P year to date, if we look at it in dollar terms. And if we look at even other exchanges within the continent, we've seen that the Ghana Stock Exchange is actually really rallying, leaving them behind. We've seen so many significant gains coming in this year, with only two laggards year to date as of Friday. So with this, I think we would like to now get into the meat and potatoes part of the presentation, which is the bond market re-entry. As I said earlier, government is seeking to come back to the bond market this year, and to see how it can best try to finance the deficit we have ahead of us. So just before we go into what the bond market is like and the likelihood of the re-entry, the likelihood of success of the re-entry of government into the bond market, I would like us to really recap, especially for those of us who are new on the market and maybe may have forgotten what happened for government to say they are planning to re-enter the bond market. I think before DDEP happened and the bond market was closed in a way. I mean, government side of it, because I think corporate bonds are still outstanding and trading. So when you look at earlier before the bond market was, we had a lot of issues on the market. We have government and some corporates who have issued bonds on the market, but government has always been the largest issuer on the market. And government was actually active on the market. And if we look at between 2016 and 2022, if we look at, we started to see, we saw government was issuing from 2018 upwards, we saw somewhere that government was actually issuing regularly, frequently, almost every year since 2016 to 2022, when we ran into economic challenges, and then we were locked out of the domestic bond market. What really happened? I think when government, since 2016, 2017, 2018, we were having, a good economic landscape, and the bond market was active, which we'll soon see when we look at the volumes and everything. We saw that about when government started to issue frequently within that short period of time. That was between 2016 and 2022. We saw what happened was that our debt book was growing significantly, and to the point that we're even getting to almost 80% of GDP, public debt to GDP, which was really alarming. And then we saw that it started dropping. But this drop here was actually because maybe I think our GDP was also growing at the same time that time. And what we also saw during that time, before DDP happened, we also saw that inflation actually spiked to higher levels, and which also triggered monetary policy, the MPC, to also tighten aggressively within that period, which made yields to really search on the secondary market as well. What we also saw that before DDP, I think when we look at the participation on our market, we saw there was a large participation from foreign investors. But moving towards 2022, when we started to face serious economic challenges, we saw a partial exit from our market, which really impacted our CD heavily on the downside, which led to persistent capital outflows from our market since 2021. So when you look at our reserves, also were also depleted on the lead up to DDP, and then also our CD. When you look at the CD and then against the other major trading currencies, we saw that there was a significant drop in our CD. And when you look at the business environment within that period, it's also started to decline somewhere in 2022. When you look at the business confidence in Ghana, as at between 2019 and 2020 and 2022, we saw a decline on the market. When we also look at our economic activity, also started to shrink, leading up to DDP. And all these things were happening, and then what we realized was that foreign rating agencies decided to downgrade Ghana, which also led to a sinking of the bond market. We saw our bonds sinking to very low prices, and then this led us to what we call the DDP. So when you look back, the market was actually a good one. It was vibrant. It was really active, and then it was open. But when we faced these economic challenges, which led to us being locked out of the domestic bond market. So when you look at after the DDP, so after the restructuring and everything, what we saw was that we saw a shift from bonds, because we're locked out of the bond market, but the bonds were still outstanding with trading. But what we saw that that part of the market was not really getting much participation again. We saw a shift from bonds to T-bills, and if we look at the bonds, actually, we saw that after DDP, trading of bonds on the secondary markets was really subdued. But what we are seeing just in a few months, we are seeing that it's beginning to actually pick up. That could be so because maybe, let's say, the market is realigning and then taking shape for that. So as I said earlier, as we see, the bond market is kind of like it's picking up bit by bit, even though it's slower. But if we look at it, it's kind of like we are seeing turnover increasing these days on the secondary market. So is it kind of like a signal that the market is ready for government to say they want to come back to the bond market? And how will that be? So one thing I would like us to look at is that um, before DDP, let's just say between 2019 and 2021, what we saw was that we saw race in teens. We saw race were in the teens, and then even though DDT has not happened at that time. We saw raise in teens and then trades were happening. The bond market was active, and until DDP happened, and then because of the economic challenges, we saw interest rates rising to higher levels. We saw inflation. We saw our reserves depleting. We saw foreign investors exiting our market. We saw our currency depreciating. What is like now is that it looks like the market yields are dropping back to where we were before DDP, and then it's kind of like everyone is saying it's too low. But then I think that time it was at those levels and the market seemed fine, and we are now back to those levels. So it could be perhaps a signal to government that, I mean, since we are back to where we were, it may be a good time to come to market to actually issue, because this was where we were before everything happened, and we have to be locked out. And then now we are back to those levels. And we also look at our reserves levels now. We've been able to rebuild our reserves level to about 11.9 billion, 11.1 billion dollars. And then if we look at before DDP, as I showed earlier, we realized that before DDP, our reserves were depleting aggressively. But now what we see is that our reserves are being rebuilt to higher levels. And it also look like our currency, as I showed earlier, before DDP and on the lead up to DDP, we saw our currency depreciating significantly. But right now, what we see is that we've seen our currency has rallied against major trading currencies, and then it's up. And then when we also look at the business environment, as I showed earlier, we saw that our business environment leading up to DDP was really in a bad state. It was deteriorating. But what we see now is that we've seen confidence is kind of like back to the market, and we've seen business and consumer confidence also soaring higher. What we are also seeing is that even though our economic activity is not really rising as expected, but we've seen that it is really improving compared to what it was before DDP. Even post DDP, we realized the economic activity was subdued, but right now we are seeing a bit of activity, even though it's actually subdued. So it could be a good sign that maybe the economic landscape, as I've showed earlier, is kind of resetting and taking shape for the market to pick up again. And we also saw that after DDP, even though our bonds, domestic bonds, sank, where we are seeing a new resurgence of that. We are seeing our bond market is kind of back live and up to higher levels. But with all this, what is really concerning now on the market is kind of the aftermath of the restructuring. So when we went through all the economic hardships and we have to restructure our debt, we are restructured our bonds, and then we push them forward by extension of maturities. And now the market is taking shape, and government is intending to come back to market. But what we are really concerned about is the obligations we have lying ahead. We've seen that when you look at the restructuring, when it was done, a lot of maturities were pushed to the 2027 and 2028. And the real question right now is if government is coming to market with all these obligations lying ahead, what tenors should they be looking at? Should we be expecting them, government, to come to market to issue a 5-year or a 7? Should they issue beyond the maturities, or it's not really something that they are considering? They will just come to market and issue at any tenor they may want, but on the market, what we are seeing is that there is a significant risk which lies ahead of us, which is 2027 and 2028, where most of the bonds are going to mature, which is going to really be kind of a stressor on the government. And then we think it may be one of the few things that may be of concern to the market if government is willing to come back to the market. Maybe if they come to market and the issue beyond that to other levels, other tenants beyond the 2027 and 2028, it may be a good one if only the market is really ready to receive that. So when you look at, just to do a quick recap, is the bond market actually positioned for bond market re-entry by government. As I showed earlier, when you look at what we are seeing this year, is that we're seeing a little bit of fiscal discipline, but the caveat is that this has always been the case for every government that comes into power. In the first few years or the first few months in power, mostly what we see is that we see fiscal prudence, fiscal discipline. We see a lot of good things happening. We see good behavior. We see government being very, 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 very careful of what they do. But along the line, just a few years, we start to kind of like reverse everything, all the good things we do. We're also seeing that as we have seen earlier, we've seen that our currency is a bit stable now. Because I think the president mentioned that he was trying to keep the currency within the 11-12 band, and then, but what we see now is it's still within the 10-11 band, and which is really a good one. I think our currency is now strong enough. As the Minister of Finance rightly said, I think the CD is back and the CD is strong and the CD is ours, and then we should really be glad for that. And what we're also seeing that we are still in an IMF program, and if when you look at our macros, most often when you look at our macros, in the times when we are in an IMF program and then when we are not, we are normally always better off when we are in an IMF program. If we look at the macros, how when you look at currency, for instance, currency actually perform way, way better when we are in an IMF program. But what is happening here is that even though we are in an IMF program, within the few years, I think the IMF program ends somewhere next year. The question right now is if we do well in an IMF program and we're about to exit an IMF program, what is the outlook going to be like? We just hope and pray that we don't get back to what we do when we are not in an IMF program. What we also see is that we are seeing, as I said earlier, we're seeing improvement in our reserves. And we also feel like if we continue to put our reserves to higher levels, government may be able to have the market confidence and also a successful bond market entry. And what we still get from investors is kind of communication from the side of government. So I think the market is expecting that if government really want to come to market and have a successful program, they should be clear on what all of its doings, which they expect to get full disclosure, and also in clear and in transparent manner. It's also something that the market is also expecting. If they get from government, it may be able to put them in the space to have a successful bond market re-entry. So when you look at some of the things that we think may kind of derail the program if government comes to market, even though the macroeconomic landscape has taken shape a bit, and then we expect it to really be within that trajectory, that growth rebounding and in growth trajectory. But there are certain key things that may really be that is of concern to the market, and which may be a possible trigger to derail the program, which is one. First off is the lingering creditor criticism. What we see is that I mean, we just went through a harsh economic landscape, which triggered a restructuring of bonds, and these bondholders are still wary of every default, especially as I mentioned earlier, the risk that lies ahead of us in 2027 and 2028. I think if government is to be able to free that debt and then also come to market and maybe look at beyond those maturities, maybe something that may really be a good one. If not, as for now, I think most some market participants are still thinking that government will not be able to honor its obligations when they are due. And as I said earlier, the market fatigue and bend fingers, I think we just left a restructuring. And most investors will also bitten at that side. So it could, may not want to re-engage government on that. When you look at the interest rate environment, and they think that right now we've seen rates coming down on the short end of the curve, but when you look at the bond market, I think rates are still a little bit high. I think maybe if the interest rate environment cools a bit, we may have increased participation. And there are also concerns about our debt levels, as we've seen the CD gains this year. So actually reduced our debt to GDP to about 40 something percent. And then it's also a good one. I think we are also looking at if government is able to take the opportunity of the stronger CD to free most of these debts and maybe a possible buyback to really reduce those debt levels to reduce our debt levels. It may also be one of the things that will be a good one for government. If not, as I now think most people still think our debt levels are unsustainable, or just some few shocks from um, global economy or some sorts may trigger us into unsustainable levels again. And one of the things that the market is also really skeptical about is how the DDP was done, the categorization approach, which really obscured the trading visibility and also the pin market illiquidity, makes the market very illiquid. I think when they did the research and then the categorization, what happened was that they grouped the investors into different categories, which kind of, I don't know whether it was because of not enough or information or clarity. It's kind of like, it's like those bonds were not intertradable, and then which made the market very illiquid with regards to the restructuring. And then it's still something that is still concerned. If if government is coming to market, we expect that all investors should kind of be treated the same with not such kind of categorization in investor type. I think this is going to be the end of today's session of the market color. Thank you for listening. We're open to discussions from participants. Let us know what you also think about whether government is going to have a successful bond market entry, and or whether will be willing to really participate on that, and how you see the macroeconomic landscape so far this year. Thank you for listening. Yeah, thank you for coming for this session. Bye.
So Gary, not buy yet. All right, thank you very much for
Okay,
the
I'm still
detailed
around.
presentation. Yeah, I think that was some great insights you've actually put across. Okay, so now this is the part where participants come in. If you already sent in your questions, I would have read it, but I don't see any questions in the chat box nor the Q&A session. So I guess people would want to add their voices directly. So please, you can feel free to signal me by raising your hand so that we allow your mic for you to share your comments, contributions, or questions. Any of these is welcome. Well, probably whilst people put their thoughts together, for me, if I were to sum up my takeaways from all that I've seen and heard from Sunkare's presentation, clearly we can tell that Ghana's economy is showing some resilience, especially within this half year. Growth is ahead of target, like he displayed. Inflation has also been moderating from 28 all the way down to 12.1. It's actually significant. We've seen the CD stage a strong rebound. So far, so good. And then at the same time, we cannot also shy away from the challenges that linger, especially around fiscal performance and then our refinancing risk based on the charts that Sunkari showed. And then also investor sentiment is very, very significant whilst we plan to re-enter the bond market. The picture obviously is optimistic, but it also reminds us that strategy and discipline matter more than ever. More than ever, I think we should put um, political expediencies aside and actually steer our economy towards greatness. Also, from Sunkari's presentation, I saw that the services sector has maintained a decade-long dominant market share. I think it's about time Ghana, as a developing country, move away from that direction. We need to strategize, skew our strategies along the patterns of industry, manufacturing, and agriculture. We cannot continue importing poultry and rice and even animal intestines from abroad. So let's produce for domestic consumption. Let's also leverage the international markets like the African Continental Free Trade Area. And then, of course, whilst we embark on this productivity or this industrialization, we would also be guided by a comparative advantage. So this would be my key takeaways from this session. The floor remains open for questions, contributions, and any other comments. Okay, we will move on to the second part of this morning's discussions. But whilst along the line, if you have any questions, you can actually chip it in through the chat box or the Q&A session. So as I mentioned earlier, we do have a special announcement coming up. And right after that, we will take a short anonymous poll based on all that we've heard today. Please stay and participate in the anonymous poll. Some of this data that you give us is what actually drive the contents of Market Color and then also shapes policy. So please, whenever you have the opportunity to actually express your views in the form of a questionnaire or a poll, kindly do so gladly because it shapes the markets in which we all find ourselves. All right, so at this point, I would invite Mr. Naneji Opokwajiman, CEO of Blackstar Brokerage, to give us the big announcement. Nana, you are welcome.
Thank you, Ernest, and good morning to fellow industry colleagues and all distinguished guests over here. And thanks for giving me the heavier heart of making the big announcement, but it's something that we are excited about. So, colleagues, once again, thanks for your time. And let me chip it in shortly that we at Blackstar are grateful for the fact that you join us every month for us to shape our thoughts and also discuss things that affect us. On the big matter of the big announcement, I have the singular honor of announcing that Blackstar Brokerage Limited has been appointed as market maker for the New Gold ETF for some time now, and we deem it fit and proper to make that announcement to the market. And I will also like to use this opportunity to congratulate our team and also thank them for the work that was put in to achieve this milestone. We are proud of the work you put in, and you've shown that with all that commitment, we can all build towards a single purpose. We are also grateful to other market stakeholders, the GSE, SEC, and people involved in the New Gold ETF ecosystem. We are grateful for the support. And I'd like to make this point clear that we are sticking to our brand promise. And with Blackstar, you should be assured of best execution. Our definition of best execution is not just in the word of it or it's being a placeholder in documentation. This is anchored on speed, accuracy, not compromising on compliance, and more especially, lower cost of transaction. So we are reaffirming our our commitment that we are going to provide you this. And I also like to let everybody within the market know that this is not a competitive move. This is to complement what exists in the market, give investors options, and by so doing, we will all deepen our market. So, once again, as it's indicated on the screen, we are officially informing you that Blackstar Brokerage is market maker for New Gold ETF. And
let me leave you with a reminder that Blackstar is open to doing business with you across our full range of services. Our global markets desk handles securities trading with precision and efficiency. We also have our asset management arm that continues to position our mutual funds for risk adjusted returns, and our investment banking team that is also available for all your corporate finance needs, from listings on both debt and equity markets to valuations, advisory, as well as capital raising. So yes, on behalf of Blackstar, I thank you very much for staying tuned. This is something we host every third Tuesday of the month, and so be expecting the September edition of Market Color. My name is Ernest Edu Owusu, and our presenter for today was Enoch Sunkari. Thank you very much. See you same time next month. Bye-bye. That for each ETF security you buy, it's actually approximately 100 ounces of gold, and it's fully backed by holdings of gold bullion with a new gold custodian, which is ICBC Standard Bank. And then also, as clearly you can see here, it's actually primarily listed in Johannesburg Exchange. However, you can also see that it's cross-listed on other exchanges like the Ghana, Namibia, Nigeria, and then the Kenyan stock exchanges. Okay, thank you very much, Daniel. So at this point, kindly stay and let's have this quick, short, anonymous poll whilst we collate some views and ideas from you to help shape policies, to help shape the market, and to also guide us when it comes to selecting topics for Market Color. All right, so it's just 2 sessions of the polls. I'm just launching the first session, which is basically about the presentation Sunkari made. There are just 6 questions in here. The first one is asking about your exposure to Ghanaian debt markets currently. So just select one for us. Which of them is your primary exposure? Is it the bonds, the treasury bills, commercial papers, among others? As things stand now, let us know what your primary exposure is. If you go to the next question, it's asking you to describe your current level of confidence in Ghana's debt sustainability. So like Sonkari mentioned, post DDEP, we saw that some confidence actually dipped, but as things stand currently, based on our debt sustainability perspective, what's your current level of confidence in Ghana's debt sustainability? Third question in this session has to do with your willingness to participate in new government of Ghana bond issuances within the next 12 months, given the fact that the government is planning on re-entering the bond market. We would like to know from you, are you open to these issuances? Are you going to participate? Let us know if you would participate irrespective of the tenors. Let us know if you would only participate if it's a short-term paper, less than 3 years, or you can actually go beyond 3 years, or you think we are not ready to re-enter, or you are just unsure, so you just want some clarity from government before you make your decision. Fourth question has to do with your preference. So when the government is coming to the market, would you prefer a new issuance, or you think there should be a tap issuance where they reopen the existing categorized bonds, or they should blend both? Which one best favors you? Number 5, and this is talking about coupons. So what premium, which would exceed the 364-day T-bill rate, would make reopen bonds attractive to your institution. So when you take the 364-day interest rate, I think it's around 13. So how much of, in terms of basis points, would you want to see above the 364-day T-bill interest rate, which would make a new bond issuance attractive to you? Are you expecting 1,000 bips, which is equivalent to 1%? Are you expecting 101 to 200 basis points, or 201 to 300 basis points, or over 300 basis points? Let us know what you think. And then finally, in this session, we would like to know from you what risk concern you most with the new issuance. Is it fiscal slippages, where you think the government might not be fiscally disciplined, or revenues might not be up to target? Is it currency volatility? Is it interest rate direction, or restructuring risk? Is it liquidity in secondary markets, or lack of communication and transparency? Just select your top 2 risk concerns among these options. Okay, the final session has to do with the gold ETF. So we would like to know from you, and this is an open-ended question, what additional features or improvements would make the gold ETF rounds that we just demonstrated more beneficial for you? What would you love to see, or what do you think we can improve upon with respect to the gold ETF rounds? It's actually okay if you haven't taken the time to look at it critically, but once you get to receive it in your email, you can actually analyze it and let us know by way of feedback what you think we can do to improve it, or what you would have loved to see with respect to the ETF rounds. The second would have to do with the challenges that you've experienced so far with the buying or selling of the gold ETF. What has been your challenge so far? And then we would also like to know from you what your outlook for gold prices in the second half of the year is. Do you see it significantly increasing, or just a moderate increase? Is it going to remain stable, moderate decline, significant decline, or you are still unsure of what the outlook for gold prices is? And finally, how soon do you expect to add gold to your portfolio, or increase your existing portfolio with gold? Would you do that before the end of this month, or you seek to do that in the next 2 to 3 months, or 4 to 6 months, or sometime beyond 6 months? Or you don't have plans at all adding or increasing your gold position, or you are probably unsure? Okay, so that brings us to the end of the polls. We are going to share the results as well with you if you haven't seen yours already. But before we wrap